Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you, as always, for joining us, giving us a few minutes of your time where we can cover the topics that we find important from our investment allocation meeting, at least worthy of sharing with you. And this week, the three topics happens to be the yield curve, everybody's fun topic. It seems to be with us in a strange way for over a year now. And then what that means for recession calls. I will give that also as a disclaimer when we talk about it, but as a heads up, if there's anything this year has taught us, recession forecast should always be taken with a grain of salt. And I think if you've been around with us for a long time, you know that we certainly do. And then Andrew will give us an update on breadth and what the developments have been there over the last several weeks. So let's dig in right to the yield curve. This is something that we hit periodically. We certainly will hit every once in a while in the thirdly. And I know that we have several times here recently because we've had this strange situation where the interest rates on short-term money are higher, much higher than they are on the long term. And that doesn't make any sort of logical sense because the longer you go out, the more time you give somebody inside of a debt vehicle, the more risk you are taking. So there's supposed to be more interest rates, but the Federal Reserve controls directly, or at least very tightly, interest rates on the short part of the curve. Everything out to 2 years is really strongly under the Fed's influence, while the 10-year and out beyond is really at the whims of the market and where the marketplace sets it. There's no real Fed control at that end. So with the Fed pushing them up over the long term and being down long term, we have the situation where there's and there has been over 1% difference between the two. Now, historically, that is extreme, and you would typically will see that reversed in a much shorter time frame. But we certainly have a very aggressive Fed, and what many will call a recession indicator, and that'll be our next slide, where we could see that the odds now of a recession are 67%. And we say that if you look back over time, the blue shaded bars indicate prior recessions, and you can see that the probability odds spike on and around those periods. This is just one indicator. It is purely mathematical and based on nothing other than those two interest rates. Now, the reason it's got such a good track record is what happens to the banks. Banks borrow from us on the short end. Those very short maturities, they're paying us interest rate, and then they lend it out longer term. And so when it's costing them more on deposits than they're making on loans, they begin to contract, and that can begin to squelch growth. And that's why sometimes there's a lag between when this thing gets inverted and the economy slows down. So I don't think anybody should say that or should doubt that the odds right now are higher than normal of a recession because we're right around slow growth anyways, and inflation being spiked can change that in a heartbeat. And they remain high, but keep in mind coming into this year, the odds were similarly high on a lot of other readings, and we keep pushing that out several months. But it remains very much with us that this is just one, but an important piece of our economic puzzle. So making the move now from the economic side onto the market side, Andrew, I'll pass the ball over to you and cover breadth.
Thank you, Adam. And something that we often talk about in our allocation meetings is that while we want to keep an eye on the economy, what we trade are markets. And so that's really what we try to keep on the front burner with keeping that eye still on the economy. But really what matters to the most to our portfolios is really what's taking place inside financial markets on a day-to-day basis. And what a theme that we've continued to talk about each week here recently, thankfully, has been the continued improvement we're seeing within the internals of the market. What I mean by that is the individual trends of all the individual stocks. And so we know that the broad indices were driven strongly by the Magnificent Seven, the 7 mega cap stocks of the first part of the year. And now we're really starting to continue to see a broadening now. What I want to focus on first is at the bottom part of this chart, which is the percent of stocks hitting new 3-month highs. We can see on the far right-hand side there that is continuing to trend higher. In fact, just last week, over 56% of stocks had hit a new 3-month high over the prior 1 month, one of the highest levels that we've seen actually since March. So it's continuing to increase. At one point in the late first, starting the second quarter last year, this number was in the 10s and 20s. So we've continued to see a broadening out there. More stocks are rising and helping participate in the rally that we're seeing in the broad market. Now, on the other side of things, in the short term, we are seeing the index, the S&P 500, is starting to get a little bit stretched. That's what we show in the middle panel of this chart. And this simply looks at the distance in percentage terms that the index is from an intermediate long-term moving average, basically the average price over the last 150 days. And you can see right now we're at about 10% above the 150-day average. And this is something that can persist for a while. We can see after the COVID crash that we saw the market rocket higher and it stayed elevated for a long period of time. And we've seen other times where we've gotten this stretched, where the proverbial rubber band has been this pulled apart, like in January of 2018. If we look going into the COVID crash, obviously that had that market catalyst. But if we look back in January, February of 2018, we saw the market was really, really strong, similar to today. We saw participation continue to advance. And then we did see a slight pullback in the market. But because breadth was so strong, it was a very small decline, meaning it didn't last very long. And we saw the markets being able to recover within a couple of weeks. And so right now we are seeing, again, strong participation. We're seeing good movements in individual stocks. But in the short term, we are a little stretched. That rubber band has really gotten pulled apart. And that just means that we might need to see some cooling off in the market, some consolidation, maybe a little backfilling for a little bit. But the mechanics, the plumbing of the market still look pretty good right now. And we're encouraged by that. And we hope to see that continue.
Yeah, absolutely. And that broadening out is really like, water after we've been wandering in the desert. Now, maybe that's a little bit of a harsher thing, but through May, it really felt like the water sources, i.e. the returns, were just so far and few between. So that's refreshing to know that that's there. And while we may be taking a little bit of a breather, water appears to be at least more plentiful for the time being. So thank you all for giving us your time and letting us talk some market and economics with you. Always enjoy that. As always, don't forget to give us a call if we may be of service, 800-928-4001, or scan the QR code and book it electronically. So thank you so much. Have a great weekend.